Welcome everyone to this Connectpreneur Masterclass and Fireside Chat. The title is Winning Strategies for Raising Money in a Brutal Market, Part 2. I'm not sure if you were able to join us for Part 1 last June. If not, no worries. We do have it posted on our YouTube channel as well. If you're interested in looking at that, Emily can share that link in the chat. But we're excited for a continuation today with Anthony Millin, who is the CEO and co-founder of My Next Raise, and Tian Wong, who is the CEO of Opus8 and Connectpreneur. So it's going to be, like I said, fireside chat style today, and we will have about a 30 to 40 minute fireside chat followed by some Q&A afterwards. And if you have any questions at all during the presentation, please feel free to put them in the chat or private message them to me, and we'll make sure to ask them during the Q&A session. So with that, I would like to turn the time over to Tian Wong to kick us off.
Thank you, Skylar. And I'd like to greet everybody, wish everybody happy holidays. It's good to see everyone. We have a really timely and interesting topic today, especially for you founders out there that are raising right now. And I think we have a pretty good discussion planned here with Anthony. Anthony, for those of you who don't know, he's a serial entrepreneur. He's also a venture capitalist, as well as being known as one of the nation's leading startup attorneys. As Skylar mentioned, Anthony is a founder and chair of Next, powered by Schulman Rogers. And Next is a disruptive law firm. They are disrupting the way legal services are being delivered. They have unique fixed price structures and packages. It allows for expert legal advice in a way that early stage companies and startups can kind of manage their legal costs. And their model has been validated in the last almost 4 years. They've been recognized by winning several awards, including Legal Week's Startup Emerging Law Firm of the Year, Legal Week's Best Law Firm for Enabling Startup Success, and then they've also been a finalist for the American Lawyer's Most Innovative Law Firm Award, and lots of other accolades, going up against some of the biggest names in law. But I'd like to kick things off, Anthony, by setting sort of we'll do a poll. Yep, thank you, Sky. I would like to know who's on the call. We'll do a couple polls today. What stage are you? How much are you raising? And then we have some, investor readiness poll as well. But I'd love to lead off with a question for Anthony, just to sort of set the stage regarding the market context and the current realities, frankly, of fundraising. And given this current brutal market, and we've been in this brutal market for a little over 2 years, what significant shifts, Anthony, have you observed in the fundraising landscape during this sort of funding winter, particularly concerning availability of capital for Series A versus your seed and pre-seed rounds? And has there been a focus to profitability, revenue? And if so, how has that affected investors?
Great. Well, first of all, thank you, Tien and Connectpreneur, for inviting me to join you all today. To understand what's happening and what founders are feeling, it's important to also understand what funds are feeling and experiencing. So it has become and has been over this period of time that you're talking about, it's been incredibly challenging for most VC funds to raise, for emerging fund managers to raise their first funds, and for existing smaller funds to raise follow-on funds. And part of that is because there just has not been a lot of liquidity and distributions from funds to their investors, to their limited partners. And because there haven't been a lot of exits, you have many funds that are sitting with billions of dollars across the industry trapped in startups, many of them funded during the very high valuations that occurred in 2021. And so that is kind of what's underlying this this challenge, is just, even though you keep hearing there's record amounts of capital, you're seeing a lot of funds and smaller funds and first-time funds not really being able to participate in raising and having pools of capital to deploy. At the same time, you're seeing a tremendous concentration of limited partner capital in a small number of very, very large mega funds. So you're seeing, with thousands of VC funds in the US, you're seeing the top 30 funds getting almost 75% of the LP dollars that are going into this asset class. And those funds are making very, very large investments. And so you keep reading about investments of hundreds of millions or tens or even billions of dollars going into certain companies. And then you're also seeing for later stage companies and certain AI type of mega deals are absorbing billions of dollars and a disproportionate share of the capital, leaving less capital available for some of the earlier stage companies. And so if you look over the last 2 years, if you had raised seed and pre-seed, so we're still seeing more companies that are pre-seed making it to seed. And so we're, often seeing some numbers being talked about, like around 50% of pre-seed companies will make it into the seed rounds. But you're seeing a big drop off because of this lack of availability of capital for like Series A that we talked about. You're seeing a drop off in how many companies that raised their seed financings have gone on to raise Series A. And so that used to be in 2 years, some stats that people talked about were like 30 to 35%. And now you're seeing that more like 12 to 20, where 15 comes up a lot. So that is also kind of this dynamic that's going on. And so it does change the focus of what companies should be doing that are earlier stage companies, whereas an old model used to be raising as much money as you can and just spending it to grow at all costs, losing huge amounts of money, knowing that when you get to that next set of the Series A round, there'd be capital waiting for you for that next stage of growth. Now you're hearing terms being talked about like seed strapping instead of bootstrapping, where what people are talking about is you raise your seed round, but then you managing your cash more around really finding product market fit and really finding traction with customers and finding a pathway to profitability. And so you're seeing a lot of investors looking for models where a company can raise 5 or 8 or 10 million and build a very successful, profitable company. And maybe they're not trying to exit for hundreds of millions or billions of dollars, but they're having an exit for 50 million or 40 million or 80 million or 100. And because you haven't raised so many rounds of funding as a founder, you can actually walk away with more capital than you might have than if you did really big raises and got really diluted and took a really risky strategy to try to build this billion-dollar company that would need to be built to have the kind of returns because of how much capital has been raised. So you're seeing this focus, like you said, on a move to profitability as a key focus and getting there with smaller raises.
Got it. Yeah, and by the way, the result of the first poll is that about 69 or 70% of our audience today is in the seed or pre-seed range, with the rest being split between investors and Series A. Would love to put up a second poll in terms of give us some ideas of like how much money you guys are raising out there. And Anthony, another question, a follow-on question would be, drawing on your experience, which is quite extensive, what are one or two most critical fundraising lessons, especially concerning focusing on what founders can control and maintaining resilience, that will increase the likelihood of success in this market, even while they sort of, instead of the old, days, getting a big chunk, sort of incrementally financing. Do you have one or two sort of lessons you can point to?
The first one we kind of touched on a little bit, which is really focus on designing and constructing a business model that and spending the the ability and efforts that you control to get to early validation and product market fit. And, if you need to iterate or pivot quickly, do it really rapidly, but use that early time to really understand your problem, your solution, validate that your solution can work for that problem, validate that there's product market fit, that customers are prepared to buy your product or service to solve that problem, validate the business model, that at the prices they prepared to pay for it, you can see a pathway to or achieve profitability. So that is one kind of really important thing. And then another, and we can go into more detail during today's conversations, but if you do get interest, really make sure you're ready for that investment process. So, if you're chasing the bus and you catch the bus, that shouldn't be your starting point of what do I do now? You really should have surrounded yourself with a great team of advisors, like a strong startup lawyer or an accounting partner, or you should make sure that your cap table is solid and data room is clean. You understand what type of securities you want to use. You understand how much you want to raise, the runway that you're going to the runway you're going to need. All these kinds of things you can be working out with your team and with your advisors ahead of the process, so that when the process happens, you have that capability to really be ready to take advantage of it.
Yeah, let's drill down on that a little bit. I'd like to just put up our third poll, but it looks like about a third of our audience today is raising over 2 million and up, and about 20% is between the 1 and 2 million mark, which speaks to the importance of being ready to raise money. And I think we had about a fourth are in the 500,000 to 1 million sort of pre-seed area. But you mentioned investor readiness and legal. Before engaging with an investor, whether it's an institutional or a super angel group or what have you, not an angel group, because maybe they're less concerned about having your sort of I's dotted and T's crossed. But what foundational legal structure should a founder prioritize, especially when you're addressing the correct legal entity or the ideal legal entity, and as well as the critical need to align and properly vest your co-founders and key employees?
So if you're looking to build a rapidly scaling company that you're planning to bring on investors and you're planning to add employees, all in kind of the near future, in most cases, you're going to be setting up a Delaware C Corp. Now, the importance of a C Corp, one of the really important aspects of a C Corp, which is not available in a limited liability company, is if your business is eligible and qualified as a qualified small business stock under Section 1202 for that exemption, and you hold your shares for at least 5 years before you sell the company, 15 million, and in some instances, based on basis, it could be higher, but $15 million, first $15 million of gains, of taxable gains, are exempt from. And so that's a huge advantage to founders and also to investors who are going to want you to be a C Corp, because they're going to want to be also taking advantage. And under new regulations, if you hold it for 4 years instead of 5, it's 75%, and 3 years is 50%. So but that is one big reason. Another is investors will almost always require, as will many of the accelerators, require you to be a C Corp and not have pass-through tax treatment, just given their structures. So, one is this qualified small business stock exemption. Another is not having the pass-through structure, pass-through taxable situation. Also, employees are much more familiar if you're trying to incentivize employees. Early stage companies often don't have the cash to pay market rates for really seasoned, experienced employees. And so they're relying on equity to incentivize people to join the vision and build the company and to benefit from the capital growth and value of the business. And so most people understand much more and enjoy benefits if you're an employee of incentive stock options versus in an LLC, which mimics or models that through unit appreciation rights. Also, Delaware is really, even though there are some people now who are starting to ask us about Wyoming and Nevada, and you're starting to hear some of that coming up. Delaware is still overwhelmingly the choice for an early stage startup to set up their startup. Investors are very familiar with Delaware. Documents that they have are all already pre-set up in a way to work with Delaware. Most companies follow the NVCA forms as their base documents for price rounds, and those are all based on Delaware. And then they're just, we had in the last week, we've had a couple of transactions that needed filings of setting up a new company or amending that needed to happen in an hour or two. And Delaware is great about that. They have, in addition to same day filing, they have same hour or 2 hour filing. And sometimes a deal is critical to have that kind of control. And in some of these other jurisdictions, it can take significantly longer, sometimes days longer, in a situation where there's time sensitivity. In terms of founders, it is really important at the very beginning to understand how the equity is going to be allocated between founders. If you've got 2 founders or 3 founders, should it be divided equally? Has everyone been involved kind of equally in creating the idea of people taking the same level of risk, people putting in the same effort, or is one founder still working full time until a company is funded while the other founder is kind of left their safety and security of a job to take risk and build it? What are people's commitments going forward in terms of time and dollars? And then you want to make sure that you have vesting for the founder shares. And it's not only investors who want to see vesting when you have multiple founders, because they want to make sure that if they put money in on Monday, on Friday, founders don't leave and own all their shares already. They want to see things vest, but you want that kind of protection between founders. We see a number of times where either for life reasons that have nothing to do with the founder's working relationship, one founder has to leave after 6 months or 8 months or 12 months. And if you don't invest in shares, that co-founder may leave with 50% of the company, and they may leave with 50% of the company at a time that maybe there is a dispute between the founders, or you're not getting along, and how do you claw that back? And the founder who's staying is going to be working 24 hours a day, 7 days a week for the next 5 to 7 years. And so you have this complete misalignment in the ownership structure. And so vesting, which is often 4 years, sometimes if founders have spent a year getting things up and running, you may have a slightly shorter period. But the most common vesting schedule used in general and for employees as well is 4-year vesting with a 1-year cliff. And then you want to make sure that with founders, all of the IP has been assigned to the company. You don't have a situation where the founders created the technology and are still holding on to the IP. That's really important. And another really important thing up front, because so many companies that have a problem in the first year, it's like a founder dispute. And in the first couple of years, and that is often because there was an alignment between the founders. People didn't spend a lot of time up front making sure there was alignment in terms of vision, in terms of mission, in terms of who you're trying to raise money from, how much are you trying to raise? How much risk do you want to take in building this business? Do you want to raise a lot of money and grow really, really quickly? Are you raising less and growing more conservatively? What are the different roles and responsibilities and time commitments and investment commitments to the venture? And so the more time you can spend up front really getting that down, the better chance that things are going to go smoothly, because the worst is you getting traction, you've got product market fit, customers are coming on, investors are getting interested, and then you have a dispute between the founders for this lack of alignment, and it can bring everything crashing down.
Great point. I mean, I think everyone's seen or heard of horror stories where you have these issues and they could have been prevented with some, some smart proactive thinking and some good guidance. I want to shift to sort of funding strategy and investor engagement, right? So question for you would be, for founders that are trying to identify the right fit in terms of investors, what kind of advice would you give them in terms of choosing your early investors? And how can a founder proactively build relationships with potential investors before they need the funding? I know it's a big time sink, but also because you're trying to build a business. But sometimes you hear the stories about, well, VCs and investors want to follow you, they want to track you, and then when you're ready, they'll know who you are, and instead of calling them, cold down the road. And then as a follow-up to that, Anthony, the Series A market, as you mentioned, is really constrained right now. Are there any sort of alternative sources of capital, right? Such as your state funding organizations like VIPC or TEDCO, or maybe angel groups, or getting some government grants or equity crowdfunding. Are there any other types of alternative sources of capital you think early stage companies should be actively exploring beyond sort of your traditional angel group slash VC equity funding? I know that's a lot, but
Yeah. So on the investor side, you have to realize that the relationship between founders and their early investors is a very intertwined, very closely connected to the success of the business long-term relationship. You may be having those early investors in your cap table for 5 to 7 years, and we're seeing, just because it's people doing more seed rounds, safe one, safe two, safe three. We're seeing people extending before they're doing later stage rounds and before they're exiting. That can even go up to 10 years in some cases. And so that makes that relationship, in addition to who the founders pick as co-founders, as the most important relationships, in some of the most important relationships in the business. All companies, even some of the biggest name companies that you see now that are these multi-billion-dollar companies, did not have straight lines up from the original vision to the ultimate business that succeeded.
right.
Right. And while it's easy to get caught up in just reading the final result of this company is now with 6 billion or 8 billion or 10 billion, most companies that became very big companies had points that were existential, where they were days or hours or weeks away from going out of business. And when you're a founder, one of the most important relationships in the downtimes is your early investors, because they know you the best. And new investors are going to look very closely and speak to your existing investors so not only what your existing investors say, but what they do, who follows on in new rounds, who participates in follow-on rounds when the company raises money. There are times where you ran out of money in between milestones, and the only thing that's going to keep you going is a bridge investment from your existing investors who are already in the business. And so that relationship and understanding not only how the investors are going to be as investors in good times. Good times are easy. Everyone gets along great. Everything's flowing. But what happens in the bumpy parts of the growth curve? How supportive, how helpful is the investor in helping find a critical customer at the critical time that you need it, or you lose your CFO, or you lose your CT, you lose a critical position and you need to rapidly find someone to come into the company. So their ability to bring in a strong executive team member, their ability to introduce you to other funding sources and to strategic partners. And so it's okay if you have the luxury to do due diligence on investors while they're doing due diligence on you, especially if you have multiple people interested in your round. Speak to CEOs in the portfolio, see how it was, reach out to CEOs who are in the portfolio who've exited, and see what it was like to work with the VC fund during the ups and downs of building their businesses. It's also really important to find investors who are really aligned to your company. So if you're a seed stage company, you want to try to find seed stage investors who specialize and focus on the seed stage company, who are really good at supporting and helping de-risk a company through to Series A. If you're in the medical device space, find an investor who is really understands the risks and timelines of a medical device or a biotech company or a fintech company. Like, find investors who know your space, because they're also going to understand the risks of that market and be able to make introductions in much more powerful ways. And they're going to have networks that are more aligned. And then always remember to keep investors well informed. Investors will build in minimum information rights often into the agreements, where you have to let them know on a quarterly basis or an annual basis. Sometimes, depending on the stage of the company, it could be more frequent. But in addition to what you're required to do legally, it's just really good practice to treat your investors as the partner they are, and keep them informed when things are going well, and don't surprise investors. Investors don't want to get a call with 30 days of capital left, that you desperately need bridge financing because you have 30 days of money left to meet payroll. You want to be speaking to them months in advance if things are not going the way you want it to go, and to have them help you put together and construct a strategy. And then on your question about reaching out to investors ahead of time, I think it's a great idea. It's easier to get investors on the phone if you're not desperately looking for money at the moment you're trying to reach them. And sometimes if you find an investor who likes you, your team, your space, but doesn't feel you're quite ready for them stage-wise, and you can connect with that investor and just introduce yourself and say, I'm not looking for money today. I'm going to be looking for money 12 months from now. But I know you've invested in companies just like this within the portfolio, and we would love to keep you updated on our progress. Investors, that's very valuable for investors as well. They're always, because it gives them a chance to measure your velocity of execution, because they see where you were. They're not coming in at just an end point in time. They're watching you progress over 12, 18 months and seeing how well you're executing and the milestones you're hitting. And so that when you're ready to raise funding, you're starting far down the road with them already in terms of their appreciation for particularly execution risk. And the last point that you asked about, which is really important as well, is what are some of the other alternatives for raising capital? What are some of the other places that capital can be raised from? So we talked about seed stage VC for seed stage companies, for instance. So another group who will invest in seed stage companies are angel investors. And when the stock market is doing well, and there are people who have exited businesses, and there are certain family offices who are becoming more interested in this asset class. Um, the angel investors is another group to really follow and speak to. Family offices are becoming more involved in some seed stage investing. You have um, accelerators often accelerators, especially some of the bigger ones, are increasing their check sizes and are a great resource for early stage companies like a Techstars, for example. Um, you have grants like SBIR grants and other type of grant opportunities that are non-dilutive and often available for the really risky early stage um, development that sometimes investors aren't. You have crowdfunding is another platform that is, we see a number of crowdfunding platform deals a year. Um, you have strategics that have all set up, innovation does not come from big companies. Innovation comes from you, from the founders, from startups. And big companies know that. And so sometimes big companies, a number of them have set up corporate venture capital arms, and they will look to seed and invest in, for strategic reasons, not just financial reasons, early stage companies. And so that's another group of investors. If you get to the point that you actually have a product, customer financing is a fantastic way to do things, right? If you have a product or service that customers are paying for, that's revenue, and that revenue can be used for future growth and development. If you've reached profitability but aren't still able to get to just say an A round, um, there's credit lines if you've kind of got the right financials. There's revenue-based financing where if you're generating revenue, there are certain types of funds who will invest based on kind of sharing in revenue instead of equity-based funding. And finally, for certain businesses who have strong contracts with strong counterparties, even though you're giving up some of your revenue, you can factor. So you can look at that universe of options and decide where you are and which levers you can potentially pull on to get some of the capital that you need.
Great. Thank you so much for that answer. I mean, a lot of what you said resonates with me for sure. Obviously, I read a stat recently that said that the average founder VC relationship is now approaching the number of years that the average marriage that ends in divorce is. So it is like picking a spouse, picking that investor and doing the diligence on these investors and checking references, talking to other portfolio company CEOs, things like that are really smart things to do. And I do want to add to that. I wrote a blog post on this, which I'll put in the chat about PitchBook says that 45% of your current VCs today do not have dry powder to do new deals. They're either doing follow-ons, or they're managing their portfolio, or they're only doing one or two deals a year, or they're not doing any deals at all despite outward appearances. So we call those zombie VCs. No disrespect to any VCs out there, but the fact is, like, they're out there saying they're investing, but they're not investing. So it's really tough, I think, for the founders on this call and any other founder to sort of separate the noise from the signal. I do want to move to the next topic here, which is sort of de-risking and financial execution. Um, can you say a few words about sort of the key categories of risk? Um, because there's a lot of risk, right? That investors are always looking to de-risk. And in addition to that, maybe you can chat about some of the instruments like safes and convertible notes and how founders can understand the differences and implications of these various securities, especially when they're stacking multiple seed rounds with different caps before they get a priced round.
Yeah, so in terms of the risk, the big risks that investors are looking at and measuring is they're looking at execution risk is is a key risk. So how strong is this team and their ability to execute? They're looking at market risk. So, product market fit. If, is this something that the market is going to be receptive to? They're looking at product or technology risk, which is how hard is it going to be? How much risk is in the underlying solution, building the product, building the technology? And then they're looking at capital risk, which is, what is it going to, some businesses require massive amounts of capital. Some businesses require smaller amounts of capital. Some businesses will require fewer rounds, some will require more rounds. But what is the capital risk involved? The biggest risk the big risks that early stage investors are looking at, to me, one of the most important ones is the execution risk at the seed stage, because the biggest thing they're betting on at the very beginning is the team.
Yeah.
Right? You see how many businesses pivot and iterate and adjust their vision and their strategy as they get feedback from the market. So the team is kind of the biggest part. And so you want to manage that risk. You start with the founding team, and hopefully the co-founders kind of complement each other and fill in gaps that one founder has maybe versus the other. But then you want to surround your team with great advisors. So, build an advisory board of experts who have experience that you don't have. Surround yourselves with great professional service providers. Like I said before, having a great startup attorney who lives and breathes the space. Not all attorneys are equal. You don't go to your orthopedic surgeon for a heart issue. And so it's no different in law. Really understand the specialty and expertise and on the banking and accounting and insurance, like really surround yourself with great resources. And if you have a gap, there are more and more people interested in being affiliated and involved with early stage startups. There's nothing more dynamic, more exciting, more rewarding, more challenging than building a startup company. And so there are a lot of great talented people who are coming in on like fractional CXO basis. Chief marketing officer, a chief revenue officer, a chief financial officer. And so there are more choices in terms of filling your dealing with your execution risk that way as well. So those are the risks. That's kind of one of the really big risks. As far as early stage financings, the overwhelming number of early stage financings are done with safes, for pre-seed and seed. They're done with safes and convertible notes. And while safes are, in the big picture, relatively new, they're now for pre-seed. Some of the statistics show that 9 out of 10 pre-seed deals are done with a safe, and seed is a little bit pre-seed and seed drop a little bit between that, but still more overwhelmingly safes. When you get to deals that are a little bit bigger and you start seeing like a deal of 3 million or more, you start to see priced rounds coming in, like a seed preferred coming in as well. So between safes and convertible notes, the big difference between them is that in a safe, you have caps and discounts. And so some safes are cap only, some are discounts, some are caps and discounts. And having an advisor working with you, an attorney working with you to just kind of explain the differences between those and when when it's good to have both a discount and a cap, or when you would only have one or the other, is important. The big difference with the convertible note is the convertible note on top of the cap and the discount have an interest rate and maturity date. So it's more complex than a safe in that you may have a maturity date where you raised, 1.5 million in a convertible note and it's a 24-month convertible note. You have to deal with the situation of you hit 24 months and you haven't had a qualified financing, an event that triggers the conversion of the convertible note into preferred stock. And you haven't sold the company, for instance, before then, and you don't have $1.5 million around to repay the convertible note. And so kind of pre-negotiating and understanding how you're going to handle those different scenarios makes the convertible notes more complex. And as I said before, it used to be safes were used for very, very small financings pre-seed, but now, we're seeing, over 80, some of the stats have over 80% or 85%, even in seed and pre-seed combined using safes. Another key point to understand is just the difference between pre-money safes and post-money safes. And most safes now are done as post-money safes. Post-money just means the pre-money is the valuation cap that you set up before the money comes in. So if you have an $8 million cap and you raise 2, the pre-money is 8, the post-money is 10. And there's more certainty with the post-money cap. The one thing to understand from a founder's perspective is if you thought you were raising 2 and you thought your valuation pre-money cap should be 8 and you end up raising 4, you oversubscribe and you decide to take double, it's the dilution is all felt by the founder. If you bring in more than you plan to when you establish that pre and post money structure, because it drops your pre-money to 6 because the post money is fixed in a post money safe. And so having people who can help you do that. And then because an A round is being stretched out, we're seeing more and more people doing multiple safes and convertible notes. So it used to be you did your pre-seed, you did one seed, then you did your A. Now sometimes you're doing 3 or 4 safes and intermixed. There's some groups who will only do convertible notes. So you've got a pre-money convertible note at a certain valuation, and then you've mixed in different valuation post-money safes. And figuring out when you do a qualified financing and all of those clear out and become preferred stock at their caps or at their discounts, what does that mean to the founder in terms of dilution? How much of the company have you effectively in these multiple safes and convertible notes, in essence, already given, sold to investors? And so when you're doing stacked safes and convertible notes, working with your startup attorney to pre-model before every next safe or convertible note, you should be doing pro forma modeling of the impact of all of that against the future dilution. You should never be surprised when you finally do your price round and all of these convert. You should have known ahead of time with each subsequent safe round or convertible note round what the impact was going to be at different scenario modeling of different priced rounds, and working with somebody who can build those very complex models with you and walk you through and make sure you're clear is really important.
Really, really good advice. And we do see a lot of that because, in this kind of environment, founders are just taking money where they can, and it can get very confusing down the road. We have about 15 minutes left. I'd love to open it up for Q&A. I'll let Skylar, our community manager, run the Q&A, and we can put questions into the chat, or you can direct message Sky or raise hand and she can call on you. But Sky, why don't you take over from here?
Yeah, that sounds perfect. So let's go ahead. We'll start the Q&A like Tian said. I'm going to put up one last poll, just in case you're interested in learning more about any of these things that we talked about today. And if you don't want to answer the poll, no worries. Just click that red X in the top left corner and it'll make it go away. Okay, so our first question is there more money being invested in follow-on funding versus new investment?
For many funds, when funds make an initial investment, they already allocate for follow-on investments. So as Tien said, there is a lot of capital that is being directed to a small number of companies within a portfolio that are kind of executing and achieving the growth projections and milestones. They're getting a lot of capital and a lot of, when Tien was talking about zombie portfolios, these are companies that are executing, they're not failing, they're profitable, but not growing at rates or have at rates that their VCs are willing to pour a lot more capital into them. So, in terms of like absolute numbers, how much is going into early stage, into first time investments versus follow on, I'm not specifically sure, but we definitely seeing a lot of the capital that's in funds today are, especially for later stage financings, are geared towards follow-on funding. And it has become more challenging outside of the seed and pre-seed rounds to get those, funds for a series. For instance, a Series A has just become, very, very hard because of that first raise in your first A round. It's challenging. It's so challenging.
Okay, thank you. What are your thoughts on using safe notes in a seed round?
We think safe note. We see most of our seed rounds are done with safe notes, and if you're the founder, that's your security of choice. You would like to do a safe if you're able to. If it's a seed round that's above a certain size, like I said, sometimes we've seen seed rounds with safes above 3 million, but that's often viewed as kind of a break point where the transactional costs of doing a preferred priced round using, for instance, NVCA documents, where instead of just the safe, you've got a 5 different documents that come together. You have a stock purchase agreement and an amended and restated certificate and an investor's rights agreement and a voting agreement and a rights of first refusal and co-sale agreement. So it's much more transactionally complex, many more terms to negotiate, a lot of protective provisions, a lot of rights and preferences that you're negotiating with investors. So you often will wait for a round that is larger in terms of size to warrant the extra transactional complexity and time involved.
Okay, thank you. What should we be looking for in our term sheet and investor agreements? For example, ROFR, tag along, info rights, etc., so that future secondary offers are streamlined if and when they happen.
It's really important, particularly when you're doing price rounds and you're starting to negotiate, have, like I said in just before, different protective provisions and different rights and preferences to really dig deep into all of these terms in terms of liquidation preferences and one of the terms, for instance, is participating versus non-participating preferred stock, and that is a term that dictates whether the investors first get to take their money back or some multiple if it's more than a one times liquidation preference that's participating, and then they get to get their percentage when with the rest of the equity. So if they own 20% of the company and they put in 5 million and it's participating preferred, they first take their 5 million out and then they get their 20% of the proceeds that are left. And so understanding all of these different rights that the preferred stockholders have and what that's going to mean in, one of the things that is happening more often is you are seeing more liquidity now because of this lack of liquidity from M&A and public offerings, you're seeing more liquidity coming out from secondaries, where a lot of the distributions that funds are making are from these secondary sales, which are happening with more frequency and don't have the same stigma that was associated with them. And so somebody is buying those shares of preferred stock, for instance, and understanding all the rights and preferences and protective provisions that go with that stock becomes important.
Yeah.
Okay, thank you. Does an LLC protect its founders from bankruptcy and the loss of their personal assets compared to a C corp?
From a liability protection point of view, the LLC and the C corp both, unless someone is piercing the corporate veil because of really bad acts that are being done, you have that the LLC protection and the C corp protection in terms of limited liability is they both protect you. The differences between them are based on strategic reasons along the lines of the ones that we spoke on before.
Okay. Tian and Anthony mentioned investor readiness, which is a very broad topic, as is designing a business model. I would be interested in their opinion of what are the major topics they need to be prepared to answer questions within.
So on investor readiness, there are kind of multiple components. There's an investor readiness from a legal perspective, for instance, is one type of investor readiness that you need to focus on. And when you're dealing with investor readiness from a legal perspective, you're making sure that your structure is in place. We talked about all of the issues and documentation, investing schedules of your founders are in place. You're making sure that your cap table is completely solid, that you've accounted for all of the equity that's been issued, that there's no promises that have been made to early consultants and advisors that have not been documented and papered and are not in the cap table. You're making sure all of your IP is protected. You're making sure that you've documented all of your agreements with your material vendors and customers, and you're making sure that you have agreements in place with all of the restrictive covenants and IP protection with your consultants and all of your employees and advisors. You're making sure if you've done financing rounds in the past, you've complied with all of the SEC and state securities regulations and have done all of the filings that have been required to be done. You're making sure that your data room is set up, that all of the documents in your data room are not only complete, but they're signed, and there's not documents missing, and there's no mistakes in the documents. All of these things become really important. And then there is investor readiness in knowing how much you want to raise to have the runway that you need. You don't want to be guessing that mid-process when people ask you how much are you raising and why. That's going to be an early question. And so you want to be able to know that I'm looking to raise 800,000 or 1.5 million, and that's going to last me 18 months. And these are the milestones that I plan to achieve. And here is my 12-month and 18-month budget for the business, which, while my revenue is unpredictable, and I can show you I really understand all of the assumptions that make up the revenue. But it's, revenue is very hard to predict. But even assuming I have zero revenue, I've raised enough money to get through the milestones that I need to get through. So having that in place, knowing if you're using a safe, if you're using a convertible note, if you're doing a priced round, or at least being able to know what your preference would be if the investor is dictating the security, and knowing having thought through the valuation cap and worked with your lawyer and your other advisors to have that ready. So all of those things come together in this bucket of investor readiness. And a lot of that is in your control. And so while a lot in the financing process is not in your control, being able to manage those aspects that are and be ready for it. One other one is on the financial side, having your 5-year financial model, and that becomes a basis of understanding your burn rate, which becomes important to your runway.
Perfect. Thank you. What is a reasonable follow-up time with potential investors?
Um, I think it depends a little bit. It depends a little bit on the investor. I don't think you want to wait too long if you haven't heard back from investors. So I think it's okay to follow up, initially within a short period of time, or at least ask up front. I mean, one of the better things to do is to ask them before the meeting ends, kind of now that you've met with them, kind of what the process is. What is their process? When do you think they'll hear back from you? You can always write to somebody. You should be writing to somebody, thanking them very soon after meeting with you, asking them for if there's any other information they need. If you haven't heard back from investors and you've had changes in milestones, sending them an update which lets them know you've just got a big new customer. So it's new information. You just got a big new customer, or you just launched a whole new module to your platform. So finding out ahead of time what their process is, sending any updates and new information is a good way to keep in touch with investors during the process.
Okay, thank you. What are your thoughts about early revenue attracting revenue investors who focus on quarter-by-quarter performance and profitability before pulling the trigger?
As I said before, we're seeing more people who, because of the lack of liquidity and how long it's taking for investors to get liquidity, we're seeing more people who are interested in revenue-based financing and in businesses that are achieving revenue and revenue growth. And you have investors who are sharing in their revenue up until some return, some pre-agreed on return. And so we kind of started today's session talking about, if you can focus on building revenue and building to profitability, the range of options that will be available to you in terms of financing choices and more kind of creative financing choices becomes greater. And that's kind of an important message in today's environment. Not for some companies, it's still very easy to raise, and based on their segment and based on what they're focusing on and the market size or the team. But for most founders, again, focusing down on pathway to profitability and revenue growth and opening up some of these alternative investment options becomes important.
Okay, thank you. And I know we're just about out of time, so I'll just ask maybe one or two more um, to finish out the meeting today. There's a couple questions about impact investors. Do you feel like they actually exist?
In certain markets, there are definitely impact investors who care about who care not only about just the financial return, but are aligned in terms of in terms of the area of the company that you're building. So, sometimes it feels now like it's harder to find impact investors, but they're definitely still investors who are looking at not only, they care significantly about what you're building and the area you're building in. And it may be a family office for whom the area you're focusing on is particularly important to their family. And there are still funds who will appreciate the area that for businesses that are looking to create an impact in an area that's important to those investors. So sometimes it may seem like it's harder to find. You can't substitute performance for impact. So you can't suddenly say, just because I'm having this great impact, I'm not, the performance of the business, the business side of growing the business, the revenue projections, the achievement of product market fit, the pathway to profitability, you still have to hit all of those, regardless of if an investor is kind of looks at themselves as an impact investor. And so either way you're executing, but if you can find somebody who's aligned to your mission and vision, they're still there.
Wonderful. Thanks, Anthony. And I want to be respectful of everyone's time. I know we're about out of time today. I do want to remind everyone that we will be sending out this recording and it will be posted on our YouTube channel. So if you missed any part of it or want to review any part of it, you will be free to do so. Just look out for that email in the next few days from us and you will have that link. But I want to thank Tian and Anthony for this class today. It was super informative. I know there's a lot of people thanking you in the chat and saying this was a great class. So just to echo what I'm saying, but with that, we will go ahead and end the class today and hope that everyone can join us at one of our upcoming Connectpreneur events. Maybe Emily, you can put a couple of those in the chat, but with that, we will end it here. Thanks, everyone.
Great. Thank you very much.
Thanks, Anthony. And thanks everyone for joining us. Happy holidays. And yeah, hopefully we'll see you next Tuesday. And if not, we'll see you soon enough.